Treasury bonds are a type of debt issued by the U.S. government to raise money for its operations. They are considered one of the safest investments in the world because they are backed by the full faith and credit of the U.S. government. When you buy a Treasury bond, you're essentially lending money to the government in exchange for regular interest payments and the full repayment of the bond's face value when it matures. Here's how it works. Treasury bonds, often called T-bonds, have a maturity of 10 to 30 years, meaning the government agrees to pay you back the full amount you invested, the principal, after this time. In the meantime, you'll earn interest payments every 6 months. These payments, called coupon payments, are based on the bond's interest rate, which is set at the time of issuance. For example, let's say you buy a Treasury bond with a $1,000 face value and a 3% annual interest rate. Every year, you'll earn $30 in interest, $1,000 x 3%, split into 2 payments of $15 each. When the bond matures, you'll also get back your original $1,000 investment. Treasury bonds are sold directly by the U.S. Treasury through auctions or in the secondary market. In the auction, investors can bid in 2 ways. Non-competitive bids. You agree to accept the yield determined by the auction, and you're guaranteed to get the bond. Competitive bids. You specify the yield you're willing to accept, but there's no guarantee your bid will be successful. The interest rate, or yield, on Treasury bonds is influenced by market conditions. If demand for bonds is high, prices go up and yields go down. Conversely, if demand is low, prices fall and yields rise. This inverse relationship between bond prices and yields is key to understanding how T-bonds work in the market. Treasury bonds are a popular choice for investors seeking stability and predictable income. They're often used to balance riskier investments like stocks because their value typically holds steady during economic uncertainty. For instance, during a stock market downturn, investors might flock to Treasury bonds, driving up their prices. However, T-bonds aren't risk-free. One major risk is interest rate risk. If interest rates rise after you've bought a bond, newer bonds will offer higher yields, making your bond less attractive to other investors. This can lower the bond's resale value if you decide to sell before maturity. There's also inflation risk. If inflation rises, the purchasing power of the bond's fixed interest payments decreases over time. Let's simplify with an example. Imagine you invest in a 20-year Treasury bond with a 2% yield. If inflation rises to 5% a year, your bond's fixed 2% interest rate will lose value in real terms because the cost of goods is increasing faster than your bond's returns.